get straight to talk about a company that was in focus in the past week itself. At CMS Info Systems, well, there was a large trade, a clean-out trade by the PE. And, the big boss in there, Mr. Rajiv, went ahead and increased stake from around 2.5% to 6.2%. Rajiv Kaul, the Executive Vice Chairman, the whole-time Director and CEO of the company, joins us on the show. Hi, Rajiv. Good morning and good to see you in the studio. Hi. We haven't had an interaction since the time we featured you on Inside Out. Now, at that point of time as well, we were saying that this is a bit of an overhang, that the PE owns a large stake in the company. Now, that's behind you. And the share has taken heart from the fact that you have gone ahead and increased stake from around that 2.5 to 6% odd. My question to you is, I think this would be, some part of that would be ESOPs. So is it a full conversion right now? Or are there some pending ESOPs to get converted? And do you want a bigger chunk in it? You've already got 6%. Are you done? Or will you want a bigger chunk?
Well, thank you for having me on the show. In the history of CMS, since we created this company, we have had a management team which has been totally aligned with shareholders, whether it's public market or private market shareholders. And therefore, stock issuances are primarily through the ESOP program, always done at fair market value to align us totally at the same way any shareholder comes into CMS. Okay. The current shareholding increase is part of my exercise of my share options issued earlier in the company. Nobody knows the future, but new ESOPs, whenever they vest basis time and performance, will get excised in due course.
So in this sale that happened from Cyan, you did not personally purchase any. Most of it was ESOP conversion, right?
My stake increase is all part of the ESOP policy and the exercise of my ESOP options. The Cyan, which is our promoters, they sell down. I think that's a different program. That's got nothing to do with my stake increase.
Okay, all right. Let's focus then on fundamentals of the business. We've got the shareholding pattern out of the way. Now, looking at the growth that you've delivered in the first 9 months, so it appears you're on track to do around 2,200, 2,300 crores of revenues for this year. Right. So give us a trajectory. This year, what did you end with? Point number one. For the next year, you all had laid out this guidance of roughly around, I think, 2,500, 2,700. Do you think you'll be at the upper end? And I believe in the coming years, it's going to be 3,500 crores. So spell it out for us. FY24, FY25, FY27 onwards.
A lot of leading questions, leading numbers. But I think I just want to set context and say in the last 2 years since listing, the company has grown at a revenue of 20% CAGR. Our PAT and EPS has grown at about 30% plus CAGR. And now, when we gave the guidance of FY25, right. Last quarter, we sort of indicated that this year end, we should be close to the 2,250, 2,300 sort of range. Next year looks like to be in the upper half of the 25 to 2,700 range we talked about. I think beyond that is very difficult to forecast right now because we are a company, we are changing, we're evolving. As we add new service lines, the revenue trajectory, and the goal really for us to compound and create shareholder value through earnings growth, which will be core businesses growing as well as adding new business lines.
So just to revise that, 2,250 odd for this year. The coming year, you're going to be looking at the upper end of that 2,500 to 2,700, closer to 2,700. And I believe by 2027, it's going to be in the 3,500 crores.
I think the FY27 is something we will be more ready to talk in a few months from now. Right now, I think we gave an early sort of aspiration saying we want to aspire to be a company of a particular size by FY27, which is 3,400 onwards sort of crores. As we finish the year, as we sort of incubate some of our new business lines, that would be the right time to actually talk about FY27.
So let's talk about those businesses itself. Let's look at your portfolio of the verticals that you run.
Sure.
There is managed services, there is cash, there are all the other verticals and some new verticals that you would be seeding as well. So when we look at your company at around 3,500 crores in terms of top line, what would be the contribution of each of these verticals versus what they are right now?
So, don't hold me to these numbers because it all depends on which businesses fire, which incubations take off or not. We estimate that a lot of this will be organic growth, right? We have historically done small tuck-in acquisitions. We really haven't focused on big M&A. Our expectation is that if you think of our technology services, which is AIoT remote monitoring, you think about software and pure managed services, I think that should be at least 10% of our revenue by FY27. If you think of our oldest business, which is cash management business, which is 70% revenue 3 years ago, close to 60, 65 now, I would estimate that'll be less than 50% at that point of time. And the remainder would be, some of the incubations and the broader managed services portfolio of businesses which we have.
In fact, on the channel, we had Mr. Saldana of New Berger, who was a participant in that large trade. And he said maybe the street was celebrating the demise of the cash management business too fast because there are other verticals as well that are growing. So I wanted to push you a little bit on that. You said that AIoT part of the business, which is managed services business, that will contribute around 10%. So ballpark, that should be in the vicinity of around 350 crores by 2027?
I think AIoT is a software business, right? I mean, these are businesses we incubated just 2 years ago. I think they're ramping up very well, growing very fast. They're already about 6% of revenue. And I would think without any M&A, I think they're on a trajectory to hit the 10% mark soon.
And what does this do to your margin profile? Because, with new age businesses coming in, that would perhaps be more margin accretive by nature of the business these are?
Well, if you actually break down our P&L and you look at the cash management business and the margins, there's actually very robust margin profile there, right? We are a large market shareholder. It's a business we've built over the last 15 years, and the margins are extremely good. I think they're world-class. But I think from our perspective, our fundamental belief is that, and has always been, that India can produce domestic-focused business services companies with world-class margins. We are one of the very few unique companies which has actually done that. And that we will aspire to have a very strong margin profile and very strong EPS growth.
So what does that mean? Margins maintained between this 28 to 30% mark, or will there be a little more than that, or you're happy with this balance?
Well, I think we're growing revenue very rapidly, right? If you think of revenue growth in the 15 to 20% zip code, I think if you are able to maintain margins in the similar zone, I think that'll be excellent.
Okay, all right. And what about your return ratios? For a company that's delivering these ROCs of 20-25% odd, margins fairly good and growing, some part of the street would believe you deserve a higher multiple. But that's going to be depending on your ratios. So what is the guidance you're going to give us on that front?
Again, I always point to our long-term track record. We talk about the past rather than the future, which is very difficult to forecast at times. If you think about our ROEs in the last 4 years have gone from about 13.5%, 14% to 21%. Our ROCs have been fairly consistent at 22, 23, 24%. And again, we pride ourselves on very good capital allocation, on being very frugal. If you think of the company, we are a company today which in its history hasn't raised any money from the public markets till now. The last time any equity came to the company was pre-2012 and less than $30 million. So I think we sort of look for compounding growth, deploying our earnings to continue our growth trajectory.
All right, so final question before we let you go from my end. I just wanted to know, very near term, how many ATMs come up for renewal? What is the kind of opportunity that you see there? And the cassette swap that was announced as well, how do these things pan out for you in the very near term?
So, if you think about the first and foremost, the cassette swap, right, which is a very big important part of RBI's plan from compliance deployment of the country. I think about the first 30 cities will be compliant in India by March or April. That would mean almost 20% of ATMs in India would actually be following a world-class, high-quality standard of fulfillment and logistics, which is, I think, very critical. I would think that this 20% has the potential to be 40 to 50% in the next 12 to 18 months as we deploy and roll out the infrastructure in new cities.
Okay, all right, Rajiv, it's been good speaking to you. We're going to hold you on these numbers that you've given us. Sure. And in fact, the first part of the business was driven by the cash management service business, the first 1,000 crores. But now the management service business seems to be catching up. So we're going to hold you on that and see how that business scales up as well. Good speaking to you. Thanks so much for coming down to the studio.